I'm Rajeev, managing partner at Orios Venture PArtners, an early stage fund with 1,000 crores deployed in 75 startups, 3 unicorns. Welcome. In a year where we have all been forced to learn new lessons in economics and investing, I'm very excited to be doing this session with Louie Gave. Louis, did I get that name spelling right?
You sure did. Thank you very much for having me, Rajeev. It's
Thank
a pleasure
you.
to be here.
Thank you. Louis Gavekal runs about $10 million of assets, $2.5 billion in Chinese fixed income, Pan-Asian equities of $500 million, $3.5 billion in private wealth, and a $4 billion robo ETF fund, which is one of the largest robotics-dedicated ETFs. He has got 6 books, including the latest, Clash of Empires, Currency and Power in a Multipolar World. He has had some very unique perspectives on the China-America relationship, and having been deeply immersed in multiple cultures, I think today will be a blockbuster. Louis is a rock star. He looks it, obviously. Studied Mandarin at Nanjing University, 20 years in Hong Kong, 2 years in the French army. That's an interesting one, Louis. And spare time dedicated to rugby, right? So, whatever, lineman, whatever you call that in, NFL, right? So that's one. He's been to India a few times as well. He tells me he once spoke Mandarin decently. I think we need to ask him a little bit more about that. Why was it once, right? Why is it not now, right? So that's one. So my job today is very simple. So my job today is very simple. Stay out of the way, because when Louis starts talking, he's mesmerizing and amazing storyteller. So the job is basically to shut up. So for me, at least, right? So I'm going to hand over to him for about 30-40 minutes for his analysis of China, its growth, opportunity, the Thucydides trap. Am I getting the spelling right? I'm sure I am. And where all of this will be moving to in terms of what the implications are, right? So that's the piece. After this, we'll move to the Q&A discussion, picking up from what you folks in the audience have suggested in terms of questions already collated, and perhaps new ones raised, which I'll request Louis to comment on. Please type your questions in the chat, so we can sort of continue to have those coming through. Look forward to a productive 60 to 70 minutes, Louis. I think the floor is yours now.
Thank you so much, Rajeev. That's a far too kind introduction. Now I have a lot to live up to. It's like when all your friends tell you a movie is terrific, and then you go see the movie and it's like, it wasn't that good.
And then you get an Oscar. I'm sure you'll do well.
Well, I'll try my best. Thank you so much. I'll just add one little piece to my bio, if I may, and that is that so I'm French, and I grew up in France, and before getting to college and university and serving in the French army, I attended a Jesuit school in France, and growing up, I was once pushed by my friends to go see one of our priests, and I asked him, Father, is it true that Jesuit priests always answer a question with another question? So he looked at me, and he said, "Who told you that?" and so today, actually, what I plan to have for you in the spirit of my Jesuit upbringing, what I plan to have for you is mostly questions. Now, I know most of you will probably have dialed in hoping for answers. I'm afraid I don't have them. All I have is questions, and I'm not even sure they're the right questions. I hope they're the right questions. And so with that in mind, I'll start off perhaps with an observation that will lead me to a question. And this observation is that, I think as human beings, and this probably dates back to 50,000 years of evolution, as human beings, we tend to be disproportionately impacted by very scary events. And again, it goes back to probably when we had to leave our caves and we had to worry about getting eaten by a saber-toothed tiger. But basically, when something really scary happens, it can sort of cloud our judgment. It overtakes our brain, and it becomes all that we focus on. So let me give you a quick example of what I mean. If I asked you, what was the scariest, not the scariest, sorry. What was the most important event of 2001? You would most likely say, you would most likely say it was 9/11. This was a traumatic event for the whole world. With the benefit of hindsight, however, we know that the most important event of 2001 was China joining the WTO. This really completely upended the global economic architecture. Or if I asked you what was the most important event of 2007, 2008, you might say it was the global financial crisis, the subprime implosion, the banks going bust, etc. Again, with the benefit of hindsight, we know that the single most important of late 2007, early 2008 was the launch of the smartphone, of the iPhone. This created a new ecosystem that has spawned so much creativity, so many new companies, and obviously all the kind of stuff that Rajeev looks at every day and twice on Sunday. With this in mind, when we look back at 2020 and 2020, 2021, what will we look back on? You'd say, well, it's obvious, it's COVID, right? This is the event that will mark a generation, just like 9/11 marked a generation. Let me suggest this, though. Let me suggest that perhaps, at least for us investors, for us those of us who have to deploy capital, perhaps a more important event, and I'll try to explain why in the rest of this presentation, a more important event over the past year was a little bit like the Hounds of Bakersville, the Sherlock Holmes story, the dogs that didn't bark, was the Renminbi. Now, throughout my career, most of my career, the Renminbi has always been a managed currency. And by and large, when global uncertainty rose, when you didn't know what was going to happen around the world, the Chinese authorities would freeze the value of the renminbi. You see this very clearly from 2008 to 2010, up here on the left of the chart. You see it again in 2015. You may remember that in 2015, China had a massive boom and bust on its equity markets. The equity markets went straight up and then came straight back down. And during that period, basically the renminbi was kept flat for 6 or 9 months. Fast forward to 2020, and here we are, biggest collapse in global trade on record, biggest collapse in global GDP on record, massive global uncertainty. And against that, you have the biggest year-on-year rise in the renminbi on record. This is a clear change of policy from the Chinese government. At the beginning of COVID, if you had asked me, what's the renminbi going to do for the next 12 months? I would have said it's going to flatline, because that's what China had done in every previous crisis, every previous of uncertainty. Today, they've gone the opposite direction. Instead of the thing flatlining, it went absolutely through the roof. Which brings me to another very important event, I think, of the past year. And that is that if you look at the first quarter of 2021, US Treasuries delivered their worst return since 1980. Now, in 1980, the US central bank, the Fed, was tightening aggressively. Volcker wanted to break the back of US inflation. Fast forward to today, and you have an opposite policy from the Fed. The Fed is out there buying $120, $130 billion worth of treasuries every month. And in spite of that buying, in spite of the Fed coming in to, in essence, try to drown out the markets, US Treasuries are delivering the same kind of horrible quarterly return that you saw in 1980. Polar opposite policies, same result. And that, I said I'd ask you a lot of questions. That, to me, brings me to perhaps the first important question of today, is how come US Treasuries are selling off when the Fed is buying bonds hand over fist? There's a message there. If a year ago, if we'd all thought, okay, the Fed is going to buy $120, $130 billion of treasuries month in, month out, none of us would have probably predicted that US Treasuries would crash the way they have over the past few months. So when you look at this, I think you're left with 4 possible options. The first is the bond market doesn't believe the Fed's promise. The second is the market is making a mistake. The third is the issuance is too high and overwhelming and easy Fed. And the fourth is the bond market is starting to worry about inflation. Now, to me, this is this last option that I'm concerned about, because it has ramifications for China, for Asia, and I'll come back to that in a second. But first, I just want to briefly go through the third possible option. Simply put, that the US fiscal policy is simply unprecedented. And on this, I just thought I'd highlight just a few key measures. If you look at 2020, the increase in government debt per living American was $13,000. Per working American, it was $39,000. This is simply unprecedented increase in debt per capita or per worker for any country in history. Now, the shocking thing is not only did it happen in 2020, but the number for 2021 could be even bigger. And if you're tempted to think, well, hold on, everybody's doing it, the reality is the US is doing it really 2 to 3 times as much as everybody else. If you look in 2020, Japanese debt per capita increased by $5,700. German debt per capita by 5,300. Chinese by 1,200. So basically, the increase in debt per capita in the US was more than 10 times that of China last year. Or here's another way to put this into context. If you look at the plan, the amount of money that the US has pushed into the system, that's the 5.7 trillion that the US has injected in the past, the US government has, borrowed in the past year to fund the spending, is roughly 6 times the amount of the New Deal of Roosevelt. It's 30 times the Marshall Plan that allowed Europe to recover and restructure. Now, in essence, there's nothing wrong with debt per se. If the increase in debt goes to fund productive spending that allows you to repay the debt down the road, then why not? The other big question, of course, would be how would that debt be funded? Now, today, the first big problem is that the big increase in debt isn't funding any new highways, any new motorways, subways, airports, or any productive investment, as much as it is just basically funding direct consumption. The other big question, again, is how is this debt funded? And that brings you to 3 possible options. The first is the debt is funded by tapping domestic private savings. If that happens, that can be quite deflationary. The second is the debt is funded by basically borrowing from foreigners. This is what Germany did to fund its reunification. This usually means that your currency goes up, your yield curve flattens or inverts, your real rates are very high, and that's also quite deflationary for your economy. The third possibility is that the government leans on the central bank to print money to fund its spending habit, and that's usually quite inflationary. Now, I don't think there's any doubt as to what's happening in the US today. Today, you look at the growth of US monetary aggregates at around 27% year on year. It's roughly twice what it was in the inflationary 1970s. So we have unprecedented fiscal policy funded through unprecedented money printing. And the big question is whether the US continues to go down this path or whether it now decides to stop. And it's a question, of course, that matters tremendously for asset allocators everywhere. Because if the US continues to go down this path, then it seems likely that inflation expectations will break out to new all-time highs, to new at least generational highs. And that in spite of rising yields, the US dollar will likely continue to go down. Now, I think we're all the fruits of our own experiences. Personally, I've spent most of my life in investing and looking at emerging markets. And one of my rule of thumbs for investing in emerging markets is when I see rising bond yields and falling currencies at the same time, I see that as a sign from the market that the policy settings are too loose and that it probably makes sense to leave. So if I'm invested in India and Indian bond yields go up and the rupee goes down, this basically tells me that India's policy settings are not correct. This is, of course, what we're seeing in the US today. We're seeing rising bond yields and falling US dollar. The market is telling you that until the US policy settings change, either on the fiscal side or on the monetary policy side, we have to assume that the US dollar will from now on be a structurally weak currency and that US treasuries will also be structurally weak as well. And I'll tie that back up to China in a second. But of course, China, the reason I'm highlighting all this is China doesn't live in a vacuum. China lives in a world where the US dollar remains so important. Today, after really a little more than a decade of a strong US dollar environment and a strong US Treasury environment, the world has now turned on its head, and we are now in a structurally weak dollar and a structurally weak US Treasury market. This is a very important shift in our global investment environment. For me, the big question is whether this shift is going to be, in essence, put into warp speed over the coming months and quarters through because of rising oil prices. Now, the story on oil prices is a pretty simple one. I'll start off, I thought I had the chart, but I don't, sorry. I'll start off with the simple observation that 12 years ago, the US was producing 5 million barrels per day of oil. The US then moved to producing 13 million barrels per day 2 years ago. And this production has now fallen back down to 11 million barrels per day. Now, the reason this matters is while US production is going down, US consumption over the coming months is likely to go absolutely through the roof for a very simple reason. As the US reopens, everybody will be desperate to be anywhere but their living room, their kitchen, their town. Everybody will want to get on the road and go check out somewhere else. Now, in a normal summer, the US consumes roughly 9% of global oil every day. The US consumes 9.75 million barrels per day. Last summer, of course, that was roughly 8.5 million. This summer, by all measures, I think we'll be breaking through 10.5 million barrels per day. The big question, of course, is where will that extra oil come from at a time when inventories are basically back at 4-year lows? The answer is that the US will have to import its oil. The US will have to import more oil, and they'll have to do so at a higher price. And as it does, the US trade deficit will continue to reach new lows, and petrostates, whether the Middle East, Russia, Nigeria, Venezuela, etc., will be getting richer. Now, the big problem, of course, is that as these countries get richer, what will they do with their dollars? As Russia earns more dollars, as Venezuela earns more dollars, as Saudi Arabia, Libya, the UAE, or Qatar, as all these guys earn more dollars, will they A, take these dollars and recycle them back into the US, mostly by buying US treasuries? Or will they buy something else? Last time around in 2000, they bought something else. Last time around, when you saw a big deterioration in the US trade balance linked to energy between 2000 and 2008, all the petrostates took their dollars and replaced them for euros. They bought euros because at that time, the euro was the new kid on the block. It was the new exciting asset. And so if you were the sovereign wealth fund of Saudi Arabia or the Libyan Investment Authority, you went out and you bought euro bonds. Are they going to buy euro bonds this time around? It seems highly unlikely. It seems highly unlikely because now all of a sudden there's question marks over the euro project that you didn't have 20 years ago, and of course because yields in Europe are now so ridiculously small. So the next question I'll ask you is, will the US have a strong driving season? And if, like me, you believe yes, then that means that oil prices are likely to move, to break out on the upside. And this especially if the US driving season occurs at a time where simultaneously Europe is reopening, which seems increasingly likely. In such an environment, you can expect energy stocks to outperform, yield curves to steepen further, and the US dollar to go down further. Now, what will it go down against? Well, this is where it gets interesting. Imagine yourself managing the sovereign wealth fund of Saudi Arabia, and now all of a sudden you're starting to make more money. Where do you put this money? Again, one option is US Treasuries, but US Treasuries offer you minus 2% real. So that means that over 10 years, basically almost 30% of your capital is going to be destroyed. Not a very attractive proposition. You basically get the same offer from Europe. As you look around the world and you think, where can I put my money? There's really only one country that stands out, and that country is China. China today is basically the only major bond market offering investors positive real rates. And unsurprisingly, given the setup, what are we starting to see? We're starting to see significant foreign inflows into the Chinese bond market. So now, roughly, basically, 20 to 30 billion dollars US dollars of foreign money are coming into the Chinese bond market month in, month out. Combine that with the 50 to 70 billion dollars of Chinese trade surplus, and that's anywhere from 75 to 100 billion dollars that are coming into China month in, month out. And this, of course, leaves the Chinese government with a quandary. With so much money coming in, does the Chinese government let the renminbi revalue? Well, yeah, it does. And this is happening. Few people realize this, but the renminbi, if you look at the world's major currencies, the renminbi is now the world's best performing currency on a 10-year basis, on a 5-year basis, on a 3-year basis, on a 1-year basis. On any time frame you care to look at, the Chinese renminbi is basically beating the pants out of every other major currency. Which brings me to this chart, which for me is one of the more important charts. This looks at the total returns of the various bond markets denominated in US dollars: China, US, Germany, Japan, i.e. let's call them the big four. Look at how, up until roughly a year ago, China and the US were outperforming everybody handsomely. And how in the past year, the divergence in performance between China on the one hand and everybody else on the other. US total return for bond investors in the US and Germany and Japan have all been very poor over the past year. And this in spite of an economic shock of unprecedented severity. The one place where if you're an investor and you wanted to basically deliver positive, steady returns, the one place you did manage to find that was China. And this for a very simple reason. That is that while in the Western world, the central banks have basically adopted policies of negative real rates, massive QE, massive money printing, and in essence, debasement of their currencies, China has gone 180 degrees. And while basically in the US and in the EU, policymakers are very busy stepping on the gas, out east, and especially in China, policymakers are already stepping on the brakes. And you see this whether through regulatory policies, whether through the anti-corruption drives, whether through property curbs, whether through liquidity injections into the bond markets, whether through the actions of banks. Basically, China is in tightening mode. So as investors, we're left in the odd and somewhat unprecedented situation where the largest economy in the world is stepping on the gas and the second largest is stepping on the brakes. So as this happens, I tend to believe that capital, just like water flows downhill, capital tends to flow to where it's best rewarded. And so if China is going to decide, we're not going to follow the West's lead, we're going to reward capital, then we shouldn't be surprised that so much of the world's capital is now flowing out east. So what we're really witnessing today is almost a reverse Asian crisis. I started my career in Asia just before the Asian crisis. And, the Asian crisis, for all intents and purposes, was a massive transfer of purchasing power from the Asian consumer to the Western consumer. All of a sudden, the German tourist could go very cheaply on holiday in Phuket. The American consumer could buy very cheap Korean-made televisions, so on and so forth. There was a massive transfer of purchasing power. Capital flowed from east to west, and purchasing power flowed from east to west. Well, today, the COVID crisis is the reverse of that. It's a reverse Asian crisis, where Asian currencies are being re-rated, and purchasing power is moving from the west back to the east, and capital is moving from the west back to the east, begging the question of how will China recycle these large capital inflows. Now, the first thing it is trying to do is perhaps, slow down these capital inflows. And I think that's been one of the drivers for the crackdown on the internet sector in China, because that was one of the sectors that foreigners were throwing money at. But apart from that, how will China recycle its large currency inflows? Well, it could buy US treasuries, which is what it's done in the past. However, given the geopolitical situation, that seems quite unlikely. It could turn around and buy commodities, and in fact, it is doing just that, buying iron ore, buying copper, buying oil, etc. It can allow the renminbi to appreciate, which is what is happening. It can buy foreign assets, and if it does, it's more likely to buy these foreign assets into emerging markets. Perhaps it could buy gold. But when you look at the policy grid, what are you left with? In the Western world, you have very easy money. In China and in most of Asia, you have, in essence, the beginning of a tightening of monetary policy. If you look at the fiscal front, the Western world, very easy. Again, across the East, in China especially, but elsewhere as well, the beginning of a tightening of fiscal policy. The end result should be steeper yield curve in the West, flattening or inverted yield curves in the East. Weak currencies in the West, strong currencies in the East. Acceleration in the West, and accelerating inflation in the West, and inflation remaining in check thanks mostly to a stronger FX in the East. Now, as we go through the reverse of the Asian crisis, if the Asian crisis was a huge deflationary shock for the world, then what would the reverse Asian crisis be? I think it seems pretty obvious that it'll be a big inflationary shock for the world. And in that regards, I'd like to point out that if you think back of the crisis of 2008, the crisis of 2008 was a crisis of bust banks. Now, bust banks are always extremely deflationary. The 2020 crisis was not a crisis of bust banks, and banks have actually withstood the crisis quite well and are now, doing pretty well. So 2008 deflationary hit that we don't have today. Post 2008, we had tighter fiscal policy pretty quickly. You had the US Tea Party that froze government spending, UK austerity, EMU crisis. For now, you see no tightening of fiscal policy whatsoever. Post 2008, you had accelerating globalization. You had the G20, the creation of the G20. More importantly, you had China's response to the 2008 crisis was to unleash a wave of capital spending and infrastructure spending such as the world had never seen, which de facto brought roughly 500 million Chinese workers onto the global economy. Before 2008, if you were producing in China, it meant that you were producing in Shanghai or in Shenzhen. Post 2008, producing in China means that you could be producing in Zhengzhou, in Chongqing, or in Wuhan. Now, of course, post 2020, we now realize that the Wuhan price may not be as cheap as we once thought it was. And so now we're moving towards an accelerating globalization to basically reshoring of supply chains and to increase regionalization. Post 2008, you have a flat renminbi. Today, you have a strong renminbi. Post 2008, you have excess supply. Today, you have supply chain dislocations. So the investment environment basically could not be more different. Well, it could always be more different, but it's massively different today than it was in 2008. And so, as we sit here and we see inflation accelerating on the back of unprecedented fiscal and monetary policy, on the back of rising energy prices, food prices, metal prices, on the back of rising mortgage rates, surging shipping rates, higher lumber, low automobiles inventory, supply chain disruptions, etc. I'm left struggling thinking, where will the deflation come from? And if we don't get another deflationary hit, then the inflation environment could easily feed on itself, if only because of the very, very important policy shift in China. China is shifting its business model from a business model that was based on keeping its currency undervalued, embracing financial repression to capture the growing current account surpluses and recycling those into infrastructure spending so as to offer the world third world infrastructure at first world prices. China, with its revaluation of the renminbi signals to the world that it is changing its business model. So, as I look at the world today, I think we're moving from a world of weaker renminbi, falling bond yields, falling oil prices, and a stronger US dollar, to a world of rising renminbi, rising bond yields, rising energy prices, and a weaker US dollar. The investment environment has thus been turned on its head. Now, for me, one big question is whether portfolios have already adjusted to this new reality. I think it seems unlikely, not in such a short period of time. Confronting this as inflation accelerates, Western central banks will soon have to make a choice whether they sacrifice their bond markets and allow yields to rise, or whether they sacrifice their currencies. I think they will sacrifice their currencies. And as they do, this will only further accentuate this reverse Asian crisis that I've just discussed. Now, of course, whenever you look at, you make your investment scenario, you have to think, how could I be wrong? What would make me change my mind? What are the key risks out there to the scenario? The first key risk for me is that Europe could blow up again. Basically, I'm assuming that Europe reopens in the coming months, not even months, weeks. If Europe doesn't reopen, if Europe doesn't have a proper summer, I think you'll have riots in the streets all over Europe in the fall. People will be so upset because Americans are having a summer, the Brits are having a summer. So if the French, the Italians, the Spaniards don't get a summer, they'll riot in the fall. So that's one key risk. But I'm assuming we do get a summer. Another key risk, of course, is that U.S.-China tensions seem to be on the back burner for now. Biden seems to be happy to basically try to keep things on the same even keel where Trump had left them off. There doesn't seem to be much appetite in the administration for further deterioration in the China relationship. Not that they're looking to cure anything for now, but if things stay on an even keel, then yeah, by and large, that it shouldn't be a concern. The obvious way the U.S. could take down China is by basically blocking China from the U.S. dollar payment system. In essence, try to do to China what the U.S. has already done to Iran, to Libya, to Sudan, to Russia. In essence, classify China as a rogue nation. Now, if we did go down this path, this would be a shock to the system that would be greater than the Lehman crisis, which is why I don't think the U.S. can do it. Blocking Iran is one thing. Nobody cares because nobody does any business in Iran. But China is the world's second largest economy, so you can't just block it off of the dollar system. The third risk, I'm assuming that, a Fed today that has been sounding very dovish continues to sound dovish. And that the Fed, as inflation accelerates, the Fed continues to say, well, look, this inflation is temporary and we're going to see through it. The Fed starts changing its tune, then you could see a rally in the dollar. But failing those three key risks, I think for me, the investment environment has changed. And the big change this time around in the investment environment is that, all of us, I assume all of us on this call, have lived our entire lifetimes with the Fed, in essence, beating the tune to which everybody else dances. The Fed being the major central bank that decides when we start to tighten. That's how we've lived our entire lives. In this cycle, you've started to see China tighten first. And this could be a first cycle where China starts, if not to call the tune for the entire world, at least starts calling the tune for itself and for perhaps a large part of Asia as well. And on this, Rajeev, I'd love to take any questions that you might have.
Thank you so much. I think you've taken the Jesuit school of learning to heart clearly, because all of the questions have come back at us, right? So deeply insightful, and thank you so much for the insights and the data that you've put together, Louie.
Pleasure.
One quick question that I thought I would start off with is, I think the question to ask here is, when the rest of the world seems to have gone into loosening across the world, literally, right? Why is it that China went into tightening? Right. So I think that was one question that I thought I would get started off with in terms of thinking about it. Right. So, do you have any thoughts on that?
I have lots of thoughts. I think there's two possible answers. One is linked to China's own history, and one is linked to current geopolitics. They're not mutually exclusive, by the way. I'll start with China's own history. I think if you look at the current generation of Chinese leaders, they were basically in their early 30s when Tiananmen happened in 1989. This means that they would have actually known a lot of the guys who were demonstrating, because the guys who were demonstrating, they were all the students from Beida, from Tsinghua. These were some of the brightest guys in China, right? To go to university in China in 1989, back then, you only had about 150,000 university students in the whole of China. It was, and China turns around and out of 150,000, they gunned down 5,000 of them on their public square. This was a deeply traumatic event for the young leaders in the Chinese Communist Party. Deeply, deeply traumatic. Now, in Chinese Communist Party dogma, Tiananmen was not a demand for more freedom or a demand for liberty, etc. But the way they explained it to themselves was that at the time you had 20% inflation in China. And if you go through Marxist history, if you were brought up I was brought up in the Jesuit church, but if you're brought up in the Marxist church, if you're a heartfelt Marxist, you believe that history isn't shaped by ideas or individuals, but history is shaped by economic forces. And there is no more important economic force than inflation. So, if you're a Marxist, if you're Karl Marx, you say, look, France had 2 bad harvests. And so in 1789, there's a revolution and Louis XVI lost his head. If it hadn't been for food inflation, there would have been no French Revolution. And if you're a Chinese Communist Party member, you say, well, look, if there hadn't been food inflation in 2011, there would have never been an Arab Spring. So, in the Chinese Communist Party mind, inflation equals social instability. Social instability means you perhaps lose power. And these guys are first and foremost in the game of staying in power. Let's not kid. Well, like most politicians anywhere, they're in the game of staying in power. And so, what I'm trying to highlight is, while in the Western world, policymakers don't care much about inflation, in China, they do. China is like the one part in the world where you still have inflation hawks. So that could be the first explanation. Everywhere you're seeing the higher inflation creep up everywhere. They see this, they tighten, because they live in their mind in a world where inflation equals revolution. So we can't take that risk. So that's the first possible explanation. The second explanation is that, look, if you're China, if you're Xi Jinping, here's what you think. I believe. You think the US is out to get me. And, there's enough proof of that. Now, you could say he went looking for it, but regardless, you think if the US if I fall, the US will have no problem kicking me while I'm down. The US will have no problem stabbing me in the back. So that's the first thing. The US is out to get me. The second thing is, what's my biggest vulnerability? My biggest vulnerability is that I still fund all my trade in US dollars. And in funding all my trade in US dollars, I remain 100% dependent on the ability and willingness of American banks to fund me. And so if one day the US really wants to plant the dagger in my back, all it has to do is cut me off the dollar system. So, there's an urgency to me basically de-dollarizing my trade, to me de-dollarizing my economy. Now, how do I do that? Well, to do that, I have to make the renminbi a credible currency. If I turn to Korea or Indonesia or Pakistan or whoever else, and I say, hey, look, let's start trading in Renminbi, the other, and forget the dollar, just, from now on you save in Renminbi and you trade in Renminbi, the guy on the other side of the table is going to say, okay, but how do I know you're not going to screw me over and devalue this thing? And so the reality, I think, is China has no choice but to de-dollarize, which means it really has no choice but to build a strong and credible currency that people want to save in and want to trade in and want to keep working capital in. And so, I think that's the main reason the renminbi has been the world's strongest currency for the past decade, because it is a geopolitical necessity for China. And that's what I talk about in my book, Clash of Empires.
Thank you. Thank you. So the other related question that comes, and that's, I think, a direct corollary to what you were just saying, is what happens now if you look at it from the US perspective on the dollar reserve currency? I think thanks to the petrodollar system and what the US has done by exporting its deficits across the world, it's created this hegemony that allows it to sort of play this reserve currency thing, and hence export away all its problems to the rest of the world almost, right? So what now changes, given that China, the number 2 economy, the largest consumer of commodities, and the economy that decided that it will not buy the T-bills after 2013, and it has sort of started to circulate that dollars into Belt and Road to acquire further assets and so on and so forth. What happens now to the reserve currency status for the US, and how does this pan out over the next few years?
Well, I think to be honest, it just gradually gets eroded. The first thing I'd highlight is, every year for the past 10 years, even though the US dollar has been pretty strong, the US dollar share of international reserve has basically been shrinking every year. And today I think we're down to 57%. We're sort of losing 1% a year, so it gradually gets eroded. But it doesn't mean it disappears overnight. The way I think of reserve currencies is a little bit like computer systems. Rajeev, I'm going to assume, well, you're most likely on Microsoft. And the reason you're using Microsoft as an operating system is that everybody else uses Microsoft. So in your firm, when you hire somebody new, you can just assume that he comes in and he knows how to use PowerPoint and he knows how to use Excel. You give him his computer and off he goes. And also, if you and I want to share a financial model, you can email me the Excel. We're all on the same system. And currencies are the same thing. The reason most people use the US dollar is not because they love the United States. The reason India buys its oil in US dollars from Saudi Arabia is not because India is such a huge fan of the US, but it's because everybody else does it. Now, this means that to replace the US dollar as a reserve currency, if we use this Microsoft analogy, you can't come up with something that's like roughly the same or marginally better. You need to be massively better, right? For you to, like, if I come to you with an operating system that's like, hey, look, it's almost as good as Microsoft, you're going to say, yeah, no interest. Thank you very much. You're like, why am I going to go through the hassle of changing my whole IT infrastructure? And so, there's an embedded advantage to being the legacy reserve currency. Having said that, you could say that somebody has managed to challenge Microsoft, and that somebody, of course, has been Apple, right? If you walk into an architect's firm today, if you walk into a newspaper editing room, etc., chances are it will be on Apple. And where Apple was especially successful is actually, if you go back to 2006, 2007, Apple was trading at 7-8 times earnings. And most investors thought, yeah, Apple, it's a nice stock. They produce some nice gadgets. But the reality is, Apple will never be able to compete for the IT spend at Goldman Sachs, or for the IT budget at Walmart, or for the IT budget at Volkswagen. Microsoft will always own that. And that was true. Apple did something that was quite bright. They basically said, you know what, we're not even going to try to compete for the IT budget at Walmart. Instead, we're going to create another operating system, a parallel operating system, and we're going to go straight to the consumer. So they create iOS, they create the smartphone, they create the iPad, and they basically target the high-end consumer in the Western world and in the emerging markets. And they basically, bypass the IT department, right? And in so doing, they actually leapfrogged Microsoft. Not that Microsoft disappeared, not that Microsoft imploded. Microsoft is still around, it's doing fine, but it nonetheless got leapfrogged by Apple. Why do I highlight this? Well, because that's exactly what China's doing on the currency front. China, over the next year and a half, is going to be launching the digital renminbi, which in essence is a parallel infrastructure. It's like a parallel operating system to the US dollar that is bypassing what would be the corporate IT budgets, i.e. the banks, the corporate IT departments, i.e. the banks, and going straight to the consumer. The pitch that China will make is basically, you're an entrepreneur in Indonesia, you go to Singapore, why don't you just pay your taxi, your hotel, your food, your restaurant, whatever else, with your Alipay, with your WePay. It settles automatically in digital renminbi, frictionless, no cost, and no exchange rates, and it's all very clean. And now you could say, well, the entrepreneur in Indonesia won't want to do that because now all of a sudden the Chinese government will know, where he spends his money, how he spends his money, etc. And 10 years ago, I would have believed that. I would have said, who wants the Chinese Communist Party to know where they're spending their money? But I think the big lesson of the past 10 years is that people will give up privacy for convenience every day of the week. We see it with people putting Alexas in their home, right? With using Google browsers, etc. People have, the past 10 years have taught us using Facebook. The past 10 years have taught us people time and time again will give up privacy if you offer them convenience. Now, the digital renminbi will have one massive advantage, and that is that, once China decides to roll it out in earnest, it'll have a billion users in the first 6 months. Now, if you look at, I'm sure you've seen these charts of, how many years it took for 1 billion people to have a fax machine, and 1 billion people to have a telephone, and 1 billion people to have a TV. I think it took like 50 years for 1 billion people to have a TV, and 30 years for 1 billion people to have a telephone, etc. It took 6 years for Facebook to have 500 million users, and it took another 2, so 8 years total for Facebook to have 1 billion users. Here China is probably going to go from 0 users to 1 billion users of its digital currency in 6 to 9 months. It will be, the fastest billion ever. And so this will most likely change the global financial landscape in a way that I think most people are completely underestimating today.
I agree entirely. So I think related to that. So by the way, there is an Indian parallel to the billion users fast as well. So that was the Aadhaar system, which was our biometric ID.
True.
We got pretty much the entire country onto it in the space of 2 or 3 years, and that was done about a decade ago, I think.
And that must be the record for the billion fastest user.
At that point in time, it was until the digital renminbi comes along, I suppose. But on this front, I think the digital cryptocurrency, there are a few questions that have come up in the audience. So one question is really, given that this digital renminbi is coming up, is that in some way linked to what's happening to the Bitcoin? It's sort of lost a lot of its edge right now. It's at the $30,000 plus. Is there some kind of a manipulation happening in the markets? Does China have anything to gain by reducing the Bitcoin? It's also gone a little on an offensive against the Bitcoin in the recent past in terms of policy decisions. Any thoughts on that?
It's a tough one. My belief is that once China launches the digital renminbi, my belief is that it may basically crush all the other cryptos, for a very simple reason, is that your digital renminbi, you'll be able to buy and sell things with. And it won't have the volatility of all the other cryptos, right? The big problem with the cryptos today is that given their volatility, they can't be a standard of value, and they're not a good store of value either. You can't have a store of value that goes up and down 30% a day. The renminbi, of course, is, it's much more stable, but more importantly, you can use it for stuff, right? So if I've owned a bunch of digital renminbi, then I can go on Alibaba and say, you know what, I need to buy myself some new, I don't know, garden furniture, or I want to buy myself, I don't know, some new headphones, and you find all these things on Alibaba, and you find them at typically much cheaper cost than you do elsewhere, which will make, a sort of, if you're a consumer today sitting in France and you think, oh yeah, prices on Alibaba are cheap, but there's a risk because the way I get the stuff, I have to wire stuff in China and I don't trust him. This guy's going to run away with my money. There's a whole, uncertainty, a level of uncertainty to it that will be taken away. So, I think once the digital renminbi comes out in earnest, the big problem is what's still the purpose for Bitcoin then? What's still the purpose for all these other cryptos? Do they all end up being like number 2 to Amazon? Who's number 2 to Amazon? Who cares? Like, who's number 2 to Facebook? Basically, does Bitcoin end up being MySpace? Do you remember MySpace?
Good enough to, yes.
No, but at the beginning there was Facebook and there was MySpace, and like, you don't need two. Like, yes. In the big challenge in the tech world is very often it's winner takes all, right? Like, there's no point in being number two. Now you could say, well, in China, JD is number 2 to Alibaba, and that's a good business, etc. And sometimes there is room for a number 2, but typically in the tech world, I think you want to be number 1.
Got it. One slightly parallel question, really. So given all this, obviously there's a lot of, fundamentals that are going right for China, and you've clearly highlighted some of them. Why is there so much of talk about the Chinese downgrades right now in terms of deteriorating condition of their financial institutions, balance sheets, and so on and so forth? What do you think is behind that?
Well, look, I think it's parts and parcels with the tightening of policy, right? You really have two choices as a policymaker today. You can, print a bunch of money and keep zombie companies alive and make sure that nobody goes bankrupt, or you tighten and you let the weaker links go bust. The Western world has clearly chosen to go down the zombie company path, and China is clearly in tightening mode, which means that I think you have to worry about bankruptcies. And that means that, perhaps right now, while you're in tightening mode, owning Chinese equities is, it's going to be tough because, that creates extra level of uncertainties, and it creates, drag on performance, number one. And then if you look at, the Chinese corporate bond market, it's also, at least the high yield part of it is quite risky. So I think if you look at the Chinese landscape today, you want to be long government bonds and perhaps underweight corporate bonds and underweight equities. So no, I'm not surprised by the downgrades. It corresponds very much to the policy choices that China is embracing today.
So one question. So as the Chinese renminbi starts to challenge the US dollar hegemony, right? Do you think the world will actually go towards another reserve currency, albeit a different one as compared to the dollar? I mean, I thought, giving too much power to one country is something that the world would have possibly thought about and said, why don't we do something else, like the basket, of currencies argument that is being made in the Europe and so on and so forth. Do you think there is any case for that?
So this is a big internal discussion we're having. And, perhaps we walk out of this to your very point, Rajeev, of saying, look, having one country have the exorbitant privilege of having the world's reserve currency creates too much instability in the system, because you end up with that country running twin deficits of 20% of GDP, which is what the US is doing today, which otherwise they wouldn't be able to fund. And because they have the reserve currency, they in essence impose their policy settings onto the rest of the world. And so it may be that on the other side of this, we move to a world without a reserve currency. That in essence, when India and Indonesia decide to trade with each other, maybe they either do it in Indian rupee or in Indonesian rupiah. We might move to a world where, let's say you want to buy something in Indonesia, and your supplier says, well, here's my price, and it's an Indonesian rupiah, and take it or leave it. And this creates a world where you could say, well, that creates a lot of risk for the individual investor, but hedging all these risks now is so easy. Now, if I do a deal tomorrow in India, and all of a sudden I have a ton of Indian rupee exposure that I don't feel comfortable with, I call my bank and I hedge that, and that takes me 30 seconds. It's like, okay, I want to sell forward, I don't know, 200 million Indian rupees. Boom, done. Now the bank quotes me the price, which is the difference in interest rates over the length of the period, and that's done. So, yeah, I think maybe in the future we just move to a world with no reserve currency, and it might make for a much more stable world. A world where at least the adjustments happen in real time instead of basically accumulating and then breaking like a dam.
Which is more crazy from a volatility perspective. Great point.
Absolutely.
So one more interesting question that's come up. So this Chinese central digital currency, right? So one of the things that the world, monetary system or whatever system is based on is the role of banks in, money supply, credit, lending, so on and so forth. And it seems to, the question really here is basically the digital currency sort of threatens to upend this banking system itself, because when the Reserve Bank or the central bank starts to directly deal with the consumer, which was never its mandate in the past, it always dealt with the banks and the banks dealt with the consumer. Now you suddenly have no need for banks because the central bank sort of takes over that responsibility, and interest rates, other things, credit policy, everything gets set by that. What do you think about that? Do you think, you mentioned that the banks are going to get stronger going forward. What do you think about the dichotomy that's coming in that conversation there?
Well, I think the banks in the Western world, where there isn't as much of a digital currency impact, I think in China, I wouldn't want to own the banks for the very reason you highlight. Well, look, at the end of the day, here's what we know. If we think of the internet as, sort of the first sort of technological big wave, the first big revolution, and the smartphone was the second. If we think of basically digital currencies being the third, what we know is every one of these things have basically killed the middleman, right? The middleman whose value was limited has been killed by these things. So, to a large degree, you could say, well, a lot of what the commercial banks do is middleman work. They get in between a saver and a borrower, and in order to make money doing it, they're doing it with more and more leverage, because otherwise it's just they really can't justify their own fees. So they have to do it with more leverage. And yes, I think the third wave, the sort of digital currency wave, I think it very much threatens the bank, no doubt about it. I would go one step further, though. If you want to go down this path. If like me, you believe that all these technological progress that we've made in the past 25 years really end up basically killing the middleman. There's still one very prominent middleman in our system that has yet to be killed, and that's the politicians. We've invented representative democracy at a time when traveling from one part of the country to the next might take forever. So, where I come from in France, I come from the southwest of France. A century ago, it would take a week to get to Paris. So, what you would do is you would send, a local guy that was trusted, maybe a doctor or a lawyer or a trade unionist or, somebody that had the people's respect. And he would go to the capital and you would represent your interests. And then he would come back every now and then and report what was happening in the capital. But today, we all know what's happening in the capital before the politicians do. information flows freely. And really, we don't, why are we paying for many layers of representative government when, we could just go down the path of Switzerland and just have, through technology and through blockchain, have elections on every important issue. Like, the Swiss vote every weekend. Through technology, we could do it through our phones now. How do you feel about this? Yes or no? Boom, done. Move on. So there's still a lot of technological progress and a lot of middlemen fat to take out. And the next big middleman fat to take out, I believe, will be in government. And here you'll have the countries that move towards direct democracy. And I think this is you're already starting to see moves towards that in some countries like Scandinavia, some of the smaller countries, the Netherlands, Scandinavia, Iceland, etc. And then you have the countries that, instead of reducing the fat in their government, keep on increasing it. This is what, of course, you're seeing in the United States. The countries that keep on increasing the fat in their government, I think, will end up the big losers in the next technological waves.
Great. Last couple of questions, as I think we are coming to the end of the conversation. One question, Louis, is, what does all this mean for the rest of the world? So as the America and China, battle sort of hots up, because obviously China is directly threatening America right now. No two ways about it. Obviously, people and countries are being forced to take sides, right? And they have to choose either this side or that side. And so how does that pan out? What do you think is the environment that's going to be? If you had a prediction, if you were looking at the future, what are the kind of things that would be interesting that would emerge from that, from an investing perspective?
I actually think, so here, partly the answer would depend on your time frame. I would say that for the next few years, I think things that will actually cool down. I think Biden is already basically signaled to China that he's going to talk a lot, but he's not going to increase the level of, tech restrictions or trade restrictions on China, et cetera. So we've now sort of reached this compromise. Now, I think what was happening is, as the US put pressure on China, China turned around and, in essence, hit on India, hit on South Korea, hit on Japan, hit on Australia, hit on all the US allies. And I use the term ally loosely because India and US aren't really allies, but I mean, friends, all hit on all those US allies in a bid to, in essence, say, look, if you want to, you might want to go on the side of the US, but don't do that, because fundamentally they're not going to come help you. So now, if the US is stopping to put pressure on China, I think the good news is China will also stop turning around and beating up on Australia and beating up on India, et cetera. So I'm looking forward to the next 3-4 years of, in essence, reduced geopolitical tensions in Asia. You might have geopolitical tensions elsewhere, but in Asia, I think we can look forward to reduced geopolitical tensions. Beyond that, the big question remains that China is an increasingly assertive power, and that either the US will have to make room for China, or things will get tense again.
Great. The last question, the summary question, Louis, you have $10 billion plus of money that you manage.
Actually, a little under.
Okay. It'll get to $10 billion plus at the pace that it's going right now, right? So $2.5 billion in fixed income in China, Pan-Asian $500 million, $3.5 billion in private wealth, and $4 billion in robotics, right? So given your thought process and where you are, what would be the portfolio construction that you're looking at going forward? What would be the kind of assets that you would be in? What would be the kind of assets that you would be out of? And hint and clue, you can't say no to venture capital, of course. Go on.
Obviously, you put all your money in venture capital. There you go. Is that a good answer? No. We're not quite at 10 billion, but in life, I think you can round up most things except your weight. So maybe I'll round up. So look, when I look at my own portfolio, like I would a rugby team. I don't know if any of you guys I know cricket is the big sport in India, but in a rugby team,
I've been to the Twickenham grounds a few times and
oh,
seen
there you go.
the Blacks play there. Yeah.
Oh, lovely. But so when you look at a rugby team, what makes rugby quite different from cricket is that in a rugby team, you need guys of really all shapes and sizes. You need some like really tall and lanky guys. You need some short, fat guys. You need some short, quick guys. You need like guys of all shapes and sizes to build an efficient rugby team. And that's how I would also build a portfolio. You need things of different shapes and sizes, things that are going to do different jobs for you. So, if I look at my rugby team and I look at my prop, the prop is the short, fat guy at the front of the scrum. Like, I don't expect that guy to run super fast. That's not what he's paid for. He's paid to push really hard in the scrum. I can't expect him to also be the fastest guy on the pitch. And that's, when I look at my portfolio, I started with that premise. Everybody's got a different job, and I'm going to judge every piece on what they're supposed to be doing. So the reason I say this is take U.S. Treasuries as an example. U.S. Treasuries, you have them in there most likely to reduce the volatility of your portfolio, to hedge your equity risk. And the reality is they've stopped doing that. In the past year, you've had three meaningful dips in U.S. equities, anywhere from 5 to 10% of the S&P 500. And over that same period, bonds went down instead of up. So bonds and equities are no longer negatively correlated. They're now positively correlated. This is an extremely important development because, for me, bonds were the prop. They were the guys, the short, fat guys who you could count on. If ever there was a fight, they're the first ones to show up. But here, all of a sudden, they're like a prop that doesn't want to fight. And a prop that doesn't want to fight is useless for you. Like it's you can fire him, get a new one. And so, the answer is, it's a long-winded answer, but I might have slides on this. Oh, no, I don't, sorry. But the bottom line, sorry, I thought I might have slides, but if you want to email me at louis@gavekal.com, I've written a number of papers on this. But you want 6 blocks in your portfolio. You want an anti-fragile block, a defensive block, an income-producing block, a growth through volume block, a growth through price increase block, and a contrarian block. Now, your venture capital piece typically is going to be part of your growth bucket, right? I mean, that's more often than not, that's why you do venture capital. And so, that can take care of that. For me, your anti-fragile piece today is Asian fixed income, and most likely Chinese fixed income, but Asian fixed income in general. Your income producing piece is energy, which happens to be also a good inflation hedge. Your defensive piece is foodstuffs, everything linked to agriculture and food. In a world where food prices are rising, this is becoming ever more important. Your contrarian stuff, for me, is European and emerging market financials, but mostly European financials. And which one am I missing? I've done defensive. Price for me. That's all the materials and frankly gold.
Great. There's one more question. Do we have time for one more?
Sure.
Okay. All right. So now this has to do with US tech, and the stranglehold they have over the global consumer base. As the US, economy and the government and the dollar starts to change its contours in terms of where it's going, what happens to US tech? Do they get stronger? Do they get weaker? Do they stay the same? Where do they go?
Well, look, I think US tech has had a lot of wind in its sail, not least of which, of course, just unbelievable growth in sales, unbelievable growth in earnings. A growth in sales and earnings that will be challenging to reproduce over the next 10 to 20 years because, you run out of new customers to find, right? If you're Facebook, if you're Google, etc. Having said that, US tech has also had some tremendous macro tailwinds. It's had a strong dollar, which has encouraged foreign investors to come into the US. It's had falling bond yields, which always favors tech. If, as I believe, we now move to an environment of rising bond yields in the US, falling US dollar, rising oil, rising renminbi. I think I'm not saying that US tech is going to collapse, but I think there's things that are more exciting elsewhere. Look, the rule of thumb is when the US dollar strengthens, you buy US growth stocks. When the US dollar weakens, you buy growth in emerging markets.
Which sounds like manna to our ears, Louis. Thank you so much. If people want to know more about you, I think you have a slide there. Do you just want to bring that slide up to,
Sure. There we go. So first, of course, feel free to email me. That first letter is an L for my first name, Louis. So it's lgave@gavekal.com. You can email our sales guys. If you want to be put on our distribution lists, you can go to our website. It's all gavekal.com, basically. And there you can find out, pretty much anything you want about us.
Fantastic. This was a fantastic session. Really enjoyed it, Louis, and appreciate your time. Thank you so much for joining us from Vancouver. You're right now in Vancouver?
That's right. I am.
Fantastic. So, have a good night. Appreciate it.
Thank you.
And thank you so much.
Thanks, Rajeev. Have a great day.